morning, traders. Today is June 19th, Sunday. We are getting ready for a very long weekend with the markets crashing last week. We've got a lot to go over right now, but I'm going to warn you that we need to stay fairly cautious over the next couple weeks. I think technology is close to bottoming. Gold and silver likely are starting to really rally. And the basic premise here is that the unwinding of the Fed is likely to continue to take place over the next 3 to 4 months, which is going to really revalue a lot of global assets. So there's a couple of things that are really going on right now. First off, everything is kind of in flux or transitioning. We need to stay cautious, and we need to be prepared for some changes in how the markets are going to work over the next 3 or 4 months. Particularly how assets are going to revalue, consumers are going to revalue, GDP is going to revalue, and the economy is going to try to find a new normal. It's basically reverting at this point, which is why I'm saying stay very cautious of trying to buy into anything right now. I will tell you that my long-term modeling systems show that risk is still on in most of the U.S. indices, and that's because the global markets are pulling into the U.S. dollar and U.S. assets as a safe haven. NASDAQ moved into bearish trending last week. We're going to get to that here in a minute. So there is some risk off taking place in technology right now, but I think we're kind of close to a bottom. I'll show you where and when I think we're getting close to a bottom in technology. So right now, I think we have a good 60, 90 days of transitioning, and we need to stay cautious right now. Could be some opportunities setting up, particularly in metals and miners, and maybe a few other ETFs. But long term, we're looking very good right now. Thanks to Brian for helping me out. I had an incorrect label here at 55. It used to be 65. Reality is we can't have 110% in our portfolio, so that was my mistake. Long and short of it, Windows has changed the viewer here, so it's a little darker, but I'll figure that out. The Fed is aggressively attempting to burst the speculative bubble, which means all asset classes are likely to devalue over the next 6+ months. My advice is to stay cautious and wait for confirmed long-term triggers. TT Scanner weekly data shows some very solid ETF trades. We'll get to those. We'll see metals continue to move higher and may see broad price swings over the next 12+ months. That's really what is taking place right now. Global central banks and the Fed are attempting to navigate a soft landing while devaluing the market, and the Fed has indicated they are going to raise rates to try to beat the inflation back, and we're going to basically see markets revert. Now, how hard this is going to revert is really going to depend on whether or not we see any type of global contagion event take place. So we need to keep our eye out on Europe, Russia, China, Asia, and particularly U.S., because the U.S. right now is leading the global markets as a safe haven. If the U.S. were to fall into some sort of a credit crisis or debt crisis or default crisis, then we could see a very deep decline. Okay, this is the wrong one. There we go. And again, it's dark. I'll fix this. It should be lighter color. NASDAQ moved to bearish last week. So technology is really unwinding and may continue to unwind. ES is still long-term bullish, short-term bearish. YM, long-term bullish, short-term bearish. Dow Jones, long-term bullish, short-term bearish. Transportation, long-term bullish, short-term bearish. SPY, long-term bullish, short-term bearish. Gold, long-term bullish, short-term bearish. Silver, long-term bullish, short-term bearish. And oils, long-term bullish, short-term bullish. Oil came down quite a bit, about 15-16% from the highs around 124 last week. It's currently at 110.48. We're looking at a real energy unwinding here, which is really consumer-driven. The Fed is raising rates. It's going to cause consumers to pull away from making big expenditures, and we may see some sort of real contagion event setting up consumer-wise with regards to credit card defaults, maybe mortgage defaults, definitely contraction in regards to spending, possibly a hiring slowdown, So we're kind of really at an early stage of a big transition right now. Let's take a look here at the TT scanner. This is the weekly TT scanner. You can tell with the little W right up here. We have a number of new signals here getting flat. These were from last week with a number of signals getting flat. But the long and short of it here, ladies and gentlemen, is we are looking at a very solid downturn here. We have a short in real estate that's 1 week old already, 9% in profits. We have a short here in internet, Dow Jones Internet's 21% profit. We have a short here in biotech that's 3 weeks old, 5% profit. We have a new short here in Jets, which is brand new. We already have a 6% profit off of this. We have a 7-week-old short in the communication sector at a 12% profit. We have a 6-week-old short in IGM, the tech sector, with a 12% profit. And we have a short in QTech with 6 weeks old with 13% profit. We still have longs up here in the energy sector in XOP, IXC, and XLE. They're 18 to 20 weeks old with 17 to 20% profit. All of the targets have been hit. Stops have been moved up. Getting fairly close to stops here. We're 60 cents away on IXC. We are, this is entry price, current price. So yes, we are 60 cents away. We are $9 away on XLE. And we are $22 away on XOP. We got in at 110, so our stops have moved up here. Their stops are pretty much at break even right now, just below break even. So the profit we've got on these trades would be protected nicely at this point with these setups. Current new trade here in Jets looks pretty good. I will say that we've got moderately strong thrusting. We've got a fairly decent profit factor. We're looking pretty good here on this new short trade, and we also have a pretty good chance here on XBI, the technology or biotech. We haven't hit any targets yet, so here's a good trade, 5% in the trade, and these we haven't hit any targets yet either. Okay, next, so we'll move on to the regular custom indexes. This is the FANGs index, and I'm going to say that we are at this 50% level. We've seen a pretty solid pullback here, but normalized price data, this normalized price channel suggests that we may come all the way back down here to this COVID high. And this really wipes out about 2.5 years worth of excesses. So be prepared that technology may continue to unwind from this 478 level to this 350 level. That's 125, so about another 23% to the downside before attempting to find support. And this moves us right down to this lower blue outward channel, this pink line here that you can see going up. I really believe this here is the area that we're looking for a bottom. So this would put us in a deeper decline, a continued weakening of the markets, possibly over the next 3 to 5 months. And then we're eventually going to find some support down here near this 350, 360 level on my custom index. That's where I think we need to be looking for a bottom, somewhere down in this lower green-blue area. I think we're still in an unwinding phase, and I'll show this to you here in a minute. The U.S. stock market index gives us another example of how this breakdown is arced right along this Fibonacci price amplitude arc. You can see we've broken down. We've continued to stay in this channel. We're accelerating as of last week. You can see we're almost down here near these COVID highs. This is the U.S. stock market custom index, so this includes some technology. I really think we're going to have to get down below this COVID high here. I really think these 2019 levels are the ultimate support level. So understand that we have 991 down to maybe 790 to 690. That's going to be a 200. So that's about another 22 roughly percent drawdown back down into this area. I think this is really where we need to get below these COVID highs. Once we get below these COVID highs and back down into this area, I think we're going to see some support. I think we're going to have enough of an unwinding that we're going to be able to actually find real price support. And then we might see a good solid bounce. We might see a 20-25% bounce at that level, trying to rebound a bit. This is the Smart Cash Index, which I call the global index. It is a combination of global and U.S. Assets, the DAX, the DK, and others. You can see we're already below COVID highs here. We've gotten down below these levels. We're entering a new accelerated trend channel here, this pink line. We get down below these levels, these recent lows here, we're going to be looking at this middle of the COVID pullback area. And I really think that's the area back down in this low. This is where we're going to try to find some support. I think the markets at this point have shown us that they're unwinding excessively. Global markets may find a bottom quicker than the U.S. markets in reality, but I think we need to get down below this 137 level down into this area. And you can see we're already in a fairly solid downtrend. So we're just going to look for this to continue to unwind and stay safe, wait it out, and find our bottoms when they set up. The custom metals index here is looking very solid off of these lows. We're going to see some big moves in metals, I think. I'm going to show you something more as we get going here, some custom indexes. But metals look very solid in my opinion. I think the unwinding of the debt excesses and the fact that global central banks are, for example, Bank of Japan is willing to print any amount of money to support their bond attempts. And I think that's going to cause metals to really start to move higher. So remember, metals, once gold gets above, say, 1970, 1980 again, look out. There's going to be a lot of focus on gold and silver. And I think that's really only a few weeks away right now. We're just waiting for a nice little impulse move here and waiting for the shock of the Fed last week to kind of wear out. Same thing happened back over here in COVID. You can see right here, we had the shock of COVID. Everything kind of broke down. That's what happened back over here. Shock of the market in March. Everything broke down. We've had a nice solid bottom. We've seen some solid support here. Now I think we're going to see 3, 4, 5 weeks of upward movement, put us back up possibly into new all-time highs for metals, and that would really draw some attention. If gold were to go to, say, 2200, we would see some really strong attention and focus on metals. Next, the valuations index. I've kind of drawn some new areas, shaded areas here. I believe we're going to move into this area, this lower red area, and stay there for an extended period of time as everything devalues. I don't think we're going to ever see this type of a move again, possibly for the next 4 or 5 years. I don't really think this excess that happened via COVID and the excesses of the Fed is going to be relived again. Now, granted, the Fed could go back to super easy money policy and ramping everything up into their balance sheets, but I think we've gotten down into this red area. I think we're going to stay in this red area, and we're going to normalize over the next 2 or 3 years into something that's going to look like a nice solid rally, but it may take 2 or 3 years to get there. So valuations have really come all the way back down. This is an excess bubble phase. It's completely unwinding, which is why you're seeing Bitcoin really fall apart. And we're down into these semi-normal levels, but we could still fall 20-25% to get down to these lows, okay? It's not uncommon to be down into this 41, 42, 43 area on these lows. So be aware. We could see, again, a 20 to 26% decrease from current levels. This is the commodity to gold index. Same type of scenarios taking place. We're down in the lower quadrant, just like I was telling you way back over here, end of last year, that this is completely unwinding. As consumers unwind out of the economy, this is going to fall back down to low levels. Now, it's going to take something to spark consumers back into this economy. So we could see this move all the way down to 0.6 or 0.7 or even lower. but consumers are unwinding out of this economy right now as the Fed is raising interest rates. So I expect this to continue to contract and really present a problem for the Fed maybe 4, 5, 6 months into the future, probably by the end of this year. Okay, the volatility index has rolled over, as you can see. I'm trying to show you more in graphics form, but we're still holding up above 6. We're at 6.17 right now. If we continue to hold above this 6.17 level or 6.0 level, we are not yet into bearish trending territory, believe it or not. This is moderate neutral. We need to see a big breakdown. We need to see something get down here in the 5s or the 4s to really indicate a big breakdown. As you can see, this lower area, when we get down into this extreme trending, this is where we get our bottoms. So you can see here's the COVID bottom coming up. Here's the late 2018 bottom set up in December. Here's the February 2018 bottom that's set up. We haven't really gotten there yet. We don't have capitulation yet in this selling. So we need to see something move down here into the 3 or 4 or 5 area, really show some capitulation selling, then we can attempt to find a bottom. That's why I think it'll continue to unwind a bit. And really what this is telling us is this is just unwinding fairly slowly. Okay, I think that's it here. Yep, that's it here. This is my long-term chart. Let me come back over to, we've done that. Okay, we're going to come here to these new Bradley custom indicators. This is the U.S. to global market index, and this shows you in red, this red shaded area here, where the global market, this is the smart cash index, the one that I showed you earlier, has already pulled back to these midpoint COVID areas. And I think this is going to be an area where we're going to likely see a bottom in the global market index. You can see it goes all the way back to the early 2017 basing level, the 2018 and 19 levels. I think this is a fairly solid area for a base and a bottom to set up in the global market index. We'll see how it holds up, but I'm hoping that this area is really going to be a bottom, and we'll just see if the global market index continues to channel in this range. This will give us a pretty good idea that the global markets, Europe, potentially Asia, have already unwound fairly solidly. A deep move down here below 0, in this case 0%, would indicate a contagion type of event taking place, a really massive unwinding event. Now the U.S. market way up here has been the benefit of huge amounts of capital rallying into the U.S. dollar and U.S. assets as this has set up a speculative phase. We still have a ways to go. I think we're going to come down here into this blue level, which is, again, the mid-COVID level. I think we're going to come down into these levels, find some support, which means we've got, again, a 20 to 25% decrease in U.S. markets from this level before we're really going to find a bottom. So I think we've got to get back into this area for both the global and U.S. index, and then we're going to potentially find a bottom here. That could be 3+ months away. The custom global asset index is still showing that we are unwinding, but we don't have any breakdown in asset valuation yet. This is showing us that inflation is still strong. It is still causing price levels to stay elevated. I do expect this to break down. I've highlighted this area here. I think that as consumers pull out of the market, we're going to see this start to move lower. You can see it is moving a little bit lower here, but we really haven't seen any big breakdown since 2007-8 right over here. And the breakdowns have really only been about 1.6 to 1.4, so probably about 10%. So from this level, we would be a breakdown possibly down into this 0.8 area. It would take something really massive to break it back down into this area. So we would need to see this really hold up. Ideally, home prices and other assets, cars and other things, will likely settle. And I think that's where we're going to see maybe a 30 or 40% decline in real assets over the next 12 months. And that could cause this to move back down here to this, let's call it 0.85, 0.9 area, back down into this area And that would be expected as consumers pull away and commodity prices decrease and general stagflation sets up in the economy. So we will see what happens here. We haven't seen anything like this since really Alan Greenspan raised rates in 2004 and 5, and you can see that caused a pretty big bump here from 1.50 to 1.75, and that's a pretty big bump. That's about if I do my math right, it's about a 15 to 20% global asset depreciation. So we are not close to that yet. We're holding up fairly well, which means the economy is still chunking right along. Asset prices haven't contracted yet to the extent that I believe they could. I believe they could come all the way back down into these areas, but I would be satisfied with something moving down here to the 0.82 to 85 area where my arrow is pointing right here, and I would call that a sufficient asset devaluation given the amount of money that has been printed over the last 12 or 15 years. I think in the long run, a 20 to 30% asset devaluation in homes and cars and other assets would be sufficient to reset the economy and see some sort of a base bottom setup. All right, we'll skip that. That's my gold cycle phases. This is from May 21, but it's still valid. We're going to get to another chart that's this chart, which will point to the same thing. This is the gold cycle phases again, and you can see we've got a nice hook up here with candles. I've drawn green arrows. We've got a good solid support system here in gold. This is gold. Ladies and gentlemen, gold and silver are really, in my opinion, getting ready to skyrocket quite a bit higher. This is the price of gold over here, 1840. We only have to go about $130 higher to break the 2000 level or 1970 level. And long and short of it, we're getting a good solid rally off of this base right now. If we see a big breakout over the next couple of weeks to the upside with gold, we're going to be off to the races. And it may not look back for 4 or 5 years. Really, it may just start to accelerate to the upside. So get ready. This is going to be a very exciting move in metals, especially as Bitcoin and cryptos and everything unwind. Next, we have the real estate conditions chart. I pull this from realtor.com data. When they update the data, they just updated it through June 11th. So remember, that is 11 days old, roughly, 8 days old, a week old. And you can see the yellow line here, which is the price reduction count, has skyrocketed to about 84% of all homes in the U.S. are being reduced in price. You can see here the active listing count has skyrocketed even higher. The median listing price, the blue line, has actually come down for the first time in a long time, many, many weeks since since February. It's been in an uptrend. We need to see it break down further. This blue line should get down into these levels down here as these price reductions continue to increase, prices will continue to come down. So you can see here, price reduction share is climbing. This is this blue line. It's getting higher and higher. This is the median days on market. It's getting higher. That means the number of days the home is staying on the market is staying on the market longer and longer. And of course, more homes are for sale right now. Everybody's trying to dump their houses. If you want out at the top of the market, you're trying to dump your house right now to any willing buyer. So we haven't seen this type of trend in a long time. We had it in 2018 a little bit. You can see here, price reductions were elevated. You can see active listing counts were elevated, but we're at levels we haven't seen in decades for the way the market is reacting. We'd have to go back to probably 2007, 8, 9 to see this type of activity. And we are still early on in this phase, meaning we haven't seen massive price reductions yet. We haven't seen the markets fall 15, 20, 30%. Although we are watching out here, I am watching houses drop, hundreds of thousands of dollars. Now, granted, these are $1 million homes dropping 10% or 15%, trying to get a buyer to come in and pick them up. But that's after seeing 50, 60% increases in prices over the last 5 or 6 years. So We have a long way to go, ladies and gentlemen. This could really unwind depending on what the market does and what the Fed does. This could really unwind over the next 12 plus months into a housing contagion again. Okay, the Consumer Engagement Index is continuing to weaken. You can see we're back here down to 2013, 14, 15 levels. This is a monthly chart. We're actually below those levels now. I really think we're going back down to these levels. You can see this spike kind of highlighted it. We're in a solid downtrend. The consumer is going to pull back, and pressure on consumers is going to get harder and harder. I'll update you with this later, but just understand, as consumers pull away and inflation continues to present a problem with gas and food and other higher costs, the natural reaction is to move away from massive expenditures, especially with raising interest rates. So be aware, consumers make up roughly 74% of GDP. So consumers are declining. They're at levels now that are back 2013, 14, 15. They're actually below those levels. We could end up back here in the early bottoming phases, which is where consumers were just pulling out of a massive contraction in the economy. And that could happen very quickly. If we get below this 0.13 level down to 0.12, 0.11, we're looking at a massive pullback in the economy, and the Fed will change its stance then. The Fed will start normalizing because everything will be contracting globally, everything. So we need to watch this, see if it gets down here, this 0.13 level. If it does, we're seeing a fairly large global contraction in the economy. Even though inflation might still be represented as high, the consumers are out to lunch. They're not engaging, and that's going to cause inflation to come spiraling down. Okay, this is the chart I wanted to show you about technology. Technology's already gotten back to these 2011-12 levels. Now, they could go lower. Look back over here, 2008 and 9, way back over here. So we have a deep selling pressure in technology. We've already unwound quite a bit of technology move. Remember the FANGs index. Let me get the FANGs index up back here. Yep, here we go. The FANGs index is showing us that we're back here near 2021 levels. This is the FANGs index. Yet the custom technology index shows us that we've unwound to 2011-12 levels. So understand that this is a broader market index, but I still believe we could weaken all the way back down here to this 0.20 or 0.18 level, which would put us way back down here in 2010, and that would equate to a minus 20%, minus 25% move in the FANGs index and technology. We still have a ways to go. This is indicating that we're at an early support stage, and we could get below this purple line into this green line level, which I think is likely over the next couple of weeks, trying to find some support. But be aware that if the consumer and the Fed continue to pull away, then we're going to see a deeper move, which is why I'm warning everyone to stay cautious and to be aware of what's actually happening, so that you can protect yourself. Okay, and then we're back to a May 21 U.S. cycle index. So those are all of the custom indexes that tell us what's going on. Let's come back over here, take a look at the SPY. And we have some lines that I drew last week. We'll shrink this down. And you can see here the lines that I drew last week indicated that we're likely going to see a move back down here to this 360 level. Look at where we were at the end of this. You can see we're down here at 365. We need to get back into this support level right in here, this blue line. Let me move this to weekly. And understand that we are now at the initial support level that I have drawn. This blue area right here, we need to get a little bit further downwards. So let's take a look at how much it's going to take to get down there. We're talking 4 to 6% to get down into this area here. And what we're looking at, that's going to be potentially our initial level of support. Get down in this area, and I think we might see some sort of support in this area depending on what the Fed does and depending on what consumers do. Now understand, if this is a wave one of a downtrend, which I don't believe it is, I think we're going to see some support in this 340, 330 area. If it is wave one of a downtrend, then we're looking at a peak here down to an area like this, followed by a recovery, followed by a more extended downturn. So we will have to see how this plays out. But we're getting set up right now for a bottom, which I have been predicting down here near this area. And I will draw this so you can see. We're looking for a bottom down in this 350 to 360 area on the SPY, and we're almost there, ladies and gentlemen. So jumping into this move right now, trying to look for a buy in this area would be premature. We need to let this continue to wind down and look for real opportunity in the market going forward. We don't have it yet. I don't recommend that anybody try to jump into this market at this stage trying to buy this bottom. We will get some confirmed triggers with my rotational modeling system, but this move is not over. My presumption of this initial bottom at the 340, 350 level, 360 level may come into play, but we're not quite there yet. Let's take a look at the NQ, which had gone bearish last week. NQ has some cycle charts here. Let's spread this out. You can see my analysis last week, and quite a bit has been that we are going to potentially attempt to find a bottom down in this area. We're not quite there yet. We have reached this area, but we have no indication of a bottom yet. We're holding above this support line, this blue support line. Ultimately, though, we have a potential for another roughly 20% move to the downside here to this 9,000 level, which I've mentioned many times as critical support. And remember, that 9,000 level comes back here to the COVID highs, this initial range right back over here. So with the technology unwinding, as I mentioned, what we may end up seeing here, ladies and gentlemen, if I can kind of draw an idea, we'll see a sell-off, a little bit of a rally, a sell-off, maybe some support before we come down to this low, and then start to see some sort of a bottom and recover from that 9,000 level, the 8,900 level. So we need to see what happens here. This is not a complete move in the NASDAQ. This does not qualify as a complete wave 3. You have an Elliott wave here structure, which does not qualify here. This wave 5 move here cannot fail and cannot end here. It needs to move lower to complete this this end phase. And that's why I'm going to warn you that this is not a bottom. I very much believe that you need to stay cautious. You need to let this unwind. We should be looking for 9,300, 9,350 at the earliest stage at a bottom in the NASDAQ. Let's take a look at gold. Remember, this is a weekly chart. Gold is holding up very well. You can see we're apexing here. And again, I've shown you that we've got this solid rally. The way I count it is 1, 2, 3, 4 already, and now we should be doing this. So I'm looking for a very solid move for gold out of this apex. We'll see how it holds up. I think that logically anything below this 1820 level is a really solid buy. I've been saying that for years. Anything down below this 1800 level is a beautiful buy. If you're able to position for this move, get ready for it. It looks like it's only a few weeks away. Let's take a look at silver. Silver is in a early stage cycle phase. You can see here this red arc. We are down here near these 2150 lows. We are holding up very strongly. Let me draw this. We are holding up very strongly down in these areas. And I do believe silver will follow gold to the upside here. Now, we do have a cycle phase top, which could occur here in August, September. But I think that the next move in metals is going to be a real solid move back up to these highs. So 26, 27, maybe 25 in silver. It all depends on what gold's going to do. If we come back to gold and take a look here. So if we look at this move from here to here and bring it back down here, gold is likely to go to 2032 on an impulse move to the upside, and if it continues to 2183 or 84, which would really put a lot of focus into gold, that would be a new all-time high. But again, this is weekly. This could take, many weeks, 12, 15, 20 weeks, another 6 months. But I believe it's just really getting started. Now let's take a look at crude oil. And crude oil has really collapsed last week. You can see this is a long-term weekly chart. It includes that wipeout in 2020. If we see this over here with moderately heavy volume, we are looking at a pretty good wipeout at this 120 level. I'd been warning this 120 level looked like pretty solid resistance. Again, consumers pulling away and the Fed trying to burst the economy means that, really you're going to have lower demand. Consumers are going to really be cutting back, and that's where oil is going to start to come back down. Now, ideally, ladies and gentlemen, we need to realize that you've got really strong support down here in this, call it $90 to $100 area, and then you've got a whole series of support back down over here between the $70 and $80 or $85 levels, call it 75 to 85. So in reality, these are the next levels for oil. Now that would be about a 40% reduction down to this level, and about a 20-25% reduction down to this level. Could very easily happen the way the Fed is trying to burst the economy right now. And global central banks are all acting together to try to navigate a soft landing, but understand that a reversion, a revaluation is going to take place. And some way that we could do this is real simply, we could take highs and lows. Let me try to pick a better high and low. So this gives you an idea that we could be easily reverting back down to this level, which would be within this range here of this excess. This was the excess of 2022, the real rally phase in related to the war. And you can see we've seen this rally phase from the speculative bubble. Everybody got rich in the speculative bubble. Houses were going up 20%, 25% a year. Bitcoin shot up. Everybody was making money. It wasn't any big deal to spend $4 or $5 for gas. Now it's a big deal. And that's why you're seeing it start to decline. Ultimately, though, this $70, $75 range probably would be a pretty good target for some support. So let's take a look at the transports. Transportation index is declining strongly. This tells you that the economy is contracting very strong. We are back very close to COVID highs. Let me draw a horizontal line. There we go. Once we get below these COVID highs around 203 for the IYT, then we get into extreme contraction. This is a pretty big psychological level. So once we get below this level, this is going to set up a message to traders and investors that we're now entering an extreme level of contraction. We're now seeing a downward move in the transportation index, which is forward thinking 4 to 6 months out into the future, that the U.S. economy is going to be contracting sharply. So if we see something back down in this 160 area, we're now in the midst of early contraction panic. If we get a big breakdown here, let me try to draw it for you. If we get a big breakdown like this into the 160 area, this would be panic. And then if we get down to 140 area, that would be an extreme capitulation, panic, downside selling, because that shows us that we're in COVID type global economy contraction that took place in early COVID. If we hold above this 200, 202 level, then we may see some support. I do believe it's going to get down to this 180, 185 level. And I do believe we're going to see some level of early stage panic over the next 2 or 3 months as the Fed does what it does. But understand, this is natural. We need to revert. We really do need to revert. You look at the IYT and you take a look at channeling. Let's see if I can do this. Take a look at IYT through the, now remember, this is 2011, 12, 13, 14. This is all the way across. And you can just take from midpoint to rough midpoint, and we can extend it out, extend to the right, and you can see where that puts us. So now if we were to then take and clone this line and move it down here off of these lows, you can see that we have a fairly easy target in this 195 level, 177 level, and 145 level. So these would be a natural reversion to extreme lows. This would be an extreme panic. This would be a moderate panic. This would be a moderate price reversion. So we're very close to a moderate price reversion right now. Okay, I think the Fed needs to burst more than just a moderate reversion, which makes this level, this 181, 178 level, come into play. Which, remember, that means that the transportation index may come down in this area, attempt to bottom for a while, and then maybe start to rally back out of it into 2023, 2024. So we have to watch this as we go forward. IYT is very important for traders to watch. It leads the economy by 3 to 6 months typically, and you can tell what's going on. You can see that we started selling off way back over here in April, May of 2021, and we've really been selling downward here aggressively since November of 2021. So this is really a good indication that we're not seeing growth in the economy. The economy is unwinding. Let's go take a look at bonds real quick. Bonds set up a beautiful doji weekly candle, which is what we were hoping for. Let's take a look at daily, see how the recovery has taken place. Nice solid recovery. We may start to move into bonds here, although bonds are still negative. They are going to start to become a real safe haven as capital shifts. Gold, silver, bonds, and the US dollar will stay the safe haven until opportunity starts to present itself in global markets and other global assets. So we may have a 6 to 12 month rally here where bonds look really good and we may start to move into it. But right now we're not. We don't have any real indication. You can see we're in a downtrend, but we do have a beautiful weekly candle with this green doji, very strong volume. This is really a great setup here for a potential bottom. It could set up what's called a three-river morning star formation, which would be a green candle next week to the upside. Too early to tell. Might be a good speculative trade, but on a deep doji like this with very strong volume, very solid indication that we might see some sort of a bottom setting up. Here's another doji with very strong volume. You can see it was about 3 weeks early before we had a bottom. So this could be a very solid bottom setting up, just too early to tell. Okay, I think that's pretty much it for now. We are going to stay cautious. Remember, follow the TT scanner triggers. These are great longer-term triggers with moderate risk. So take a look at this new trigger here. We've already got 6% profit in it. It's a $16.59 stock right now, Jets. Our stop is 1823. Our targets is 1507 and 1252. We have entry price of 1769. This was from Monday, I believe. Long and short of it, ladies and gentlemen, these give you very solid swing trade scenarios, and they will get you out of trades if the system doesn't execute well. So your stops are defined. You have a stop here, 1823. We're at 1657. So you basically got $1.50 risk on this trade. You've got targets setting up. It's a brand new trade. Look at this last trade here, this short. Haven't hit any targets yet. It's at 67.61 in XBI. Stop is at 74. So you got a $12 risk, about a 15-20% risk on this trade. You got targets set up. We're already 5% into the trade. These are very solid swing trades, and they will keep you in a scenario. Now, what you're looking for is strengthening thrust. So you want to get in at early thrust levels. So anytime you get into a new trade, like this is minus 57. This is already actually accelerated quite a bit downward in this new trade. I would be looking at thrust levels in the 20s or under range, 10 or 20. This one here at 19 in red shows that it's now starting to accelerate to the downside. These are showing you that it's accelerating to the downside. This is showing you that it's neutral. So this is a very good trigger right now. Even though it's 12%, it's a very good profit. It's a very good trigger in the sense that this 20 for negative 20 for thrust is showing you that it's got a real potential to accelerate back downward going forward. And here we have 34, minus 34 in thrust. This is beginning to accelerate again back to the downside. This is only 1 week old. So this is a pretty good trigger as well. But follow these triggers. These are your swing trade triggers. Watch them on the TradeTank.com site. That's where it's listed. You have access to these every week. These are very good triggers to set up, and they're showing you what's going on. They're showing you where you can keep your money. And remember, right now you want to trade smaller equity sizes. You do not want to bet the farm on any one of these triggers. You should have, just like I showed you back over here, you should have 55% cash, 10% stocks, 25% metal, and 10% bonds. So that means your 10% stocks of your allocation would be potentially going into this TT scanner trade. And that means you would be allocating, if you had $1 million, you would only have $100,000 total to play with these triggers. And you would want to allocate them efficiently. That means these trades should really only be about $5,000 or $6,000 total equity in each one of these trades, so that you're not risking a lot in these bigger, in these more volatile time frames. You want to stay protected, and if you're going to take these swing trades, you're going to want to trade them with very small allocation. You know, maybe a couple hundred shares, maybe 50 shares. But the long and short of it, stay safe. We do not want to get overly aggressive in this market right now. Volatility is excessive. We're close to a bottom. We're going to look for new opportunities probably in about 6, 10, 12 weeks, see how it plays out. But right now, everybody needs to stay safe and protected. The U.S. dollar is staying fairly strong. We're very well protected. Remember, I got you into cash back in August and September of 2021. I started telling you to pull away from the rally in the market, pull your profits. I kept advising you to get into 50, 60, 70% cash, wait this thing out, move into metals near the lows. And remember, that was back when metals were back over here. Let me go back up to gold. I was warning you way back over here that you need to get into metals, you need to start accumulating, you need to get prepared, move away from the markets. Remember, I was telling you way back over here, move away from the markets, get yourself into a cash position before this thing rolls over. We've been in a very solid cash position since way back over in these areas, and if you followed me, and now we've seen it roll over, wipe out a ton of debt, and capital from a ton of people, and we're likely to see it start to bottom here another 6 or 7% lower, hopefully. And so pay attention to this. Right now, ladies and gentlemen, this is what we're looking for, this bottom. And I'll keep you abreast going forward. That's it for now.